Technology surged to lead the market higher in the latest session, lifting broad indexes green while energy sank to the bottom. Direxion Semi Bear 3X ETF fell 4.6%. Score: data not available. The 4.6% slide mirrors the market's panic over Taiwan's supply disruption that could shave weeks off chip output. Without a measurable moat, the inverse fund leans heavily on macro volatility. The lab's deep dive shows why the geopolitical squeeze makes this inverse bet uniquely volatile. Direxion Daily Semiconductor Bear 3X shares dropped 4.59% to $48.42. This fund amplifies inverse daily moves of the VanEck Semiconductor ETF by 3 times. Multi-day holds suffer severe structural erosion from daily volatility reset mechanics. When underlying semiconductor equities rally, daily compounding destroys fund capital rapidly. NVIDIA commands 20.8% of underlying exposure. Taiwan Semiconductor holds 9.6%. Broadcom accounts for 6.6%. Together, these top 3 holdings represent 37% of underlying index exposure. Advanced packaging manufacturing drives structural momentum into semiconductor balance sheets. Multi-die assemblies at 2-nanometer nodes require higher capital expenditures across silicon foundries. NVIDIA continues capturing enterprise accelerator market share with massive hardware deployments. Taiwan Semiconductor maintains full capacity across sub-3-nanometer production lines. Broadcom accelerates custom ASIC silicon shipments to hyperscale cloud providers. These operational expansions generate consistent earnings momentum for underlying hardware stocks. Rising share prices across these 3 giants directly depress short ETF performance. SOXS compounds daily inverse results, magnifying benchmark gains into severe fund losses. Year-to-date performance sits at negative 91.2% due to unrelenting underlying sector upside. Holding leveraged inverse funds across choppy market structures guarantees net asset value destruction. Traders must respect daily reset math above all short-term technical signals. Structural mechanics punish extended positioning without exception. When chip leaders push higher, inverse leverage acts as an absolute drag on portfolio equity. The combination of hardware momentum and leverage decay defines this risk. Open the hood on SOXS. The largest single driving. AMD at plus 4.9%, carrying 5.7% of the fund. A 91.2% collapse year-to-date proves this triple inverse ETF bleeds capital exactly as engineered. Specific AUM and expense ratio metrics are unavailable in dataset. Without fee drag data, we evaluate efficiency strictly through holding mechanics and reset math. Fund architecture from Direxion exposes a clear structural trap for retail accounts. Marketing literature emphasizes broad semiconductor diversification. The underlying basket reveals extreme concentration instead. Top 5 holdings command 48% of total fund weight. NVIDIA alone accounts for 20.8% of the inverse benchmark. Taiwan Semiconductor holds 9.6%. Broadcom takes 6.6%. AMD represents 5.7%. Micron Technology claims 5.2%. NVIDIA and Taiwan Semiconductor alone drive over 30% of daily movements. Shorting these silicon giants puts capital directly in front of massive enterprise infrastructure spending. Over 1 month, benchmark peer SMH gained 5%. SOXS lagged SMH performance by 27.9 percentage points in that same window. Macro conditions like a 3.63% Fed rate cannot protect positions against daily compounding decay. Daily leverage resets amplify upside ticks in hardware stocks into permanent capital destruction. A 3-year average return of minus 86.2% aligns precisely with this structural design. Retail traders frequently confuse daily trading tools with multi-month portfolio insurance. Volatility drag acts as an unsustainable tax on extended holding periods. The lab concludes SOXS is an engineered intraday instrument incapable of providing long-term structural protection. SOXS is trading at a 2.9% premium to NAV, and that's not retail euphoria. It's a structural short squeeze in disguise. The 5-day volume is only 77% of the 20-day average, so this isn't a flood of new money. It's existing short positions scrambling to cover before the next reset. Institutional capital isn't flowing in, it's trapped. The fund's narrative sells you a 3x daily inverse bet on semiconductors, but the macro headlines are screaming a different story. Canada just slapped 50% retaliatory tariffs on US chips, and China is sanctioning anyone who touches Iranian silicon. That's not noise, it's a supply chain tax on the exact names SOXS is short. Meanwhile, the hardware papers confirm what the street keeps missing. Multi-die assemblies are now table stakes below 2 nanometers, and the capex cycle for advanced packaging is just getting started. That's a tailwind for the underlying index, not the short side. RSI at 55.6 and price above both the 20-day and 50-day moving averages? That's momentum, but it's momentum in the wrong direction for a daily reset inverse fund. Every uptick in SOXS is a decay function working against you, and the premium to NAV is the market's way of pricing in that decay. The verdict: SOXS is a narrative trap. The fund's marketing sells you leverage, but the flows in geopolitics are selling you a structural short squeeze that's already priced in. Before the verdict on SOXS, the engineer's warning: 3 times daily does not mean 3 times monthly. A 10% up day followed by 10% down leaves the base index at -1%, but SOXS at -9. That's volatility decay. Short-term tactical only. Know your exit before you enter. A geopolitical supply disruption across Taiwan represents the primary structural catalyst for short-term inverse semiconductor exposure. Physical wafer bottlenecks instantly freeze global hardware manufacturing capacity. That operational shock validates temporary tactical hedging mechanics. However, the core structural risk breaking this thesis is the commercial NVIDIA Blackwell chip launch. Surging enterprise demand for advanced AI accelerators creates sustained hardware momentum. That momentum forces brutal daily leverage resets on inverse products during extended market rallies. Furthermore, broader market sentiment sits in extreme greed with a CNN fear and greed reading of 74. We track 2 critical fund structure signals to evaluate ongoing erosion. First, concentration risk is dangerously high inside the underlying index. Top constituents NVIDIA and Taiwan's Semiconductor account for 30.4% of total exposure. Single stock upside surges in these 2 giants severely punish inverse performance. Second, daily leverage compounding generated a disastrous 91.2% year-to-date loss in net asset value. This vehicle vastly underperformed the broader Nasdaq benchmark over the same period. Technical signals like an RSI of 55.6 or a bullish MACD crossover cannot overcome mathematical decay. The lab assigns SOXS an AI ETF score of none out of 100 for fund structure durability. Daily reset mechanics make this product fundamentally defective for holding beyond a single session. The single metric that alters this durability judgment is combined top 2, holding concentration dropping below 20%. Top signal: SOXS data blackout. No transparency, no trade. What competitive risk deserves more attention in the SOXS story? This isn't financial advice, just engineering-level education. Markets move fast. Past performance never guarantees future returns. Always do your own research before any trade. Subscribe so you don't miss Tuesday's deep dive. We're tearing down Marvel. The lab's work is never done.